Hello guys, my name is Sir Ernest Asante and I love you. Right, we have been able to tackle tutorials from the beginning, and I told you that we are dealing with the background of accounting. We've dealt with chapter one, should I say chapter one, tutorial two, three has been posted. If you have not watched, you want to go watch. We started from the meaning of accounting, went ahead to assets, the meaning of assets and the rest. And we also did the relationship between asset, liabilities, and capital. And I want you to take a look at that. If you have not subscribed to my channel, please do share with your friends, comment, and motivate us to keep doing more. If you know any accounting students, feel free to share our videos with them, and I know it's going to bless you. Right, today we are going to do a very short lecture, and I'm trusting God to help us. Right, and what we are going to do, I said it in my other video that we are going to tackle equation accounting equation. What then is accounting equation? This is nothing new to what we have done. Accounting equation is the mathematical expression of assets and it's, or let's say because it's plural, their source of finance. So accounting equation is the mathematical expression of assets and their source of finance. Right. What are we talking about? We are saying that assets will then be equal to capital plus liabilities. So the relationship between assets and its source of finance. So assets can be financed by capital, and it can also be financed by liability. So for example, in my first book, I told you that somebody wants to sell 30 books. All right, the assets will be 30. Then it says, I have 20 books, capital, providing 20 books. Let me borrow 10 from somebody else. We are saying that your asset must be equal to your source of finance. So that is where we get it. Or for example, I'm selling an asset worth 30 cedis, and after selling the asset worth 30 cedis, I realized that I took a mortgage, or let me not say 30,000. I took some loan of about 10,000. Then it means that after paying off the loan, the rest that is left is my capital. So this is the accounting equation, right? But we are going to make it a bit complex for the benefit of the financial statement, because accounting equation is what we are going to use in the statement of financial position. I told you that types of financial statement. We have the income statement, we have the statement of financial position, we have the cash flow statement, and then we have the changes to owner's equity. We also have the notes to the account. But we are saying that this is going to help you in the statement of financial position. So let's then break it. So if we are saying assets, then it means that asset can also be non-current assets plus what? Current assets. Equal to this capital. We will now break it down. So C will be capital. But if there is any drawings, minus drawings. If there's any profit, plus profit. So we are breaking this one down. Now plus liability. I told you we have long-term liability plus what? Short-term, or you can say current liabilities. So you see, the only thing is that we have brought some things here. We brought D, which stands for drawings, I'll be explaining, and we brought P, which stands for profit. So the contribution of the owner, the contribution of the owner, we also sometimes have what we call drawings, where the owner goes to draw money, withdraw money, and anytime we make profit too, that is what we call P. So you see that this is what you've been seeing in the accounting, the financial position. This is what you have been seeing in the financial position. Your non-current assets plus your current assets, your capital. So your non-current asset plus your current asset will be equal to your capital component and your what, liability component. This is when you are using. Therefore, this is when you are using the net asset, right? The net asset approach. The net asset approach. But what if you want to use the working capital? I showed you in my other video what working capital is. So what if you want to use working capital? So now it will be equal to what? Non-current assets plus current assets. Then we'll now bring our what? Current liability. So it is plus. When it comes, it will be minus current liabilities. Equal to, it will still remain D plus P. Then now plus LL. Now you know that we must always tackle this if you are talking about working capital. I told you that working capital is your current asset minus your current liability. Your current asset minus your current liability. So when you get it and you add it to this, you have gotten one side. This side must be equal to this side. It's the same thing. So we are saying that your current assets, non-current your asset is your non-current asset plus your current asset, and then your liabilities is long-term liability or non-current liability plus your current liability, and the equity component will be your capital, any drawings that you have, and any profit that you've gotten at the end of the year. Okay, the only difference is that if you want to use the working capital component, you just substitute and bring the current liability here, so that it now gets you the what? Working capital plus your non-current asset will give you one portion. So we always say that your assets must be equal to your what? Your capital plus your liability. Or if you are using the working capital, this side must be equal to this side. So that is what we mean by the accounting equation. And as we go on, you see that, especially the accounting students, see that when you are preparing the statement of financial position, you have non-current assets. Your assets, you break it non-current asset, current asset. You add them, then you total. The total is the equal to. So the total will give you one amount. Then the next one, you come to the equity. Then you now check your equity, then you add your non-current liabilities and your current liabilities, then you add them, then you get the same thing. Or if you are using the net asset the working capital approach, you use this one that we are talking about. We'll come there. Let me not confuse you. So basically, this is your accounting equation. This is your accounting equation. Don't forget, I said it's the relationship between your assets and their source of finance. Now, I want us to look at some definitions. Number one, let's look at drawings. Now, drawings, it could be goods or cash. So we are saying that drawings is any goods or cash that the business owner takes from the business for his personal use. Remember, we said that the business entity concept says that the business is different from the owner. So, anytime the business owner goes to take something out of the business for his personal use, we must let it. We don't treat it as an expense. No, we must let it. So that's why I brought it here. Capital minus drawings, what he placed inside and what he took out. So capital minus drawings. So that is drawings. Any goods or cash that is taken out of the business for personal use. That is drawings. Let's look at expense. Expense and expenditure. We often confuse ourselves. What is an expense and what is expenditure. Now, expense is not expenditure. Okay, expenditure is a broad term. When you look at expenditure, we are talking about two things. We are talking about either capital expenditure or revenue expenditure. What is capital expenditure? Any expenditure that we incur to purchase or for the acquisition of what? Non-current assets or improvement on it. So when we incur cost to acquire an asset or improve on the asset, we say it is capital expenditure. And then revenue expenditure is any cost in anything we incur to maintain. So it did not change the status of the asset. It did not improve it, or we did not even buy new one. It was just to maintain it. So normally people say it is the expenditure for the day-to-day activities. The day-to-day activity. So that one we say it is what? Revenue expenditure. And revenue expenditure is written off in the income statement as an expense. So this is what we actually will refer to as what? Expense. But this one, we'll call it what? Cost. And this is capitalized at the financial position. So if you bought an asset, you see that we'll add the cost of it to the asset. When we come to that side, I'll show you what IS 16 will come there, what it entails to come up with the cost of an asset. You understand? So that cost, it goes to the non-current asset as financial position. You capitalize it. When you say you capitalize it, you add to the cost of the asset, whether you made improvement or you bought a new asset. So this expense, or rather be what we are talking about, the day-to-day. So it is not, expense is not the same as expenditure. Expenditure is the broad thing. Then it is the same as revenue and income. Okay, revenue and income. Revenue and income. Income is the proceeds we get from the sale of goods or provision of services. The income, the proceeds we get from sale of goods or provision of services. But revenue is the proceeds you get from what the business actually deals with. So there can be some proceeds we get from, for example, the proceeds we get from maybe the disposal of an asset. But the business does not deal with that. We deal with other things. But the proceeds we got in disposal of an asset is an income. It does not necessarily mean it is a revenue, because revenue is what we actually do. So, for example, I always love to talk about my hospital. My hospital, what we do is to provide healthcare services to people. So, anything that we do that is involved in providing healthcare to the people, we call it revenue. But income could be the fact that here we have what we call distilled water. So, what we do is that sometimes other companies come to purchase distilled water from us. That will not be what we call revenue. It's an income, but it is not what we actually deal with. I believe that this is helping you. So that will be the difference of what we call income and expenditure. Now let's look at income and then revenue. Let's look at profit and loss. These days we say it's profit or loss. They say that you make profit or loss. Profit is the excess of your income over your expense. So your income minus, so P is equal to your income minus your expense. So we are saying that the income for a particular year, when you less your expense of the particular year from it, what you get, when the income is more than the expense, you get profit. And when the expense is more than the income, you get what? Loss. As simple as that. As simple as that. This is just simple calculation. Profit. This is what our parents do in the marketplaces. Alright, they take the income, they less the expense, they say, oh, so and so. That is what we are talking about. That is what we are talking about. Let's look at quickly, today we are closing early. Let's look at purchases, purchases and sales. Purchases and sales. Now realize I didn't write purchase and I didn't write sale. I wrote purchases and sale. Sale, to sell or sale is the verb you are doing or what is happening, but sales is what have been sold. All right. Purchase, to purchase is an action word. Okay. To purchase is like to buy, but purchases is what you have bought. So in our accounts we have purchases account. That means that the items that we have bought, they are called purchases. So anytime we buy, all right, anytime we buy, they are called, the things that we have bought is purchases, and the things that we have sold is what? Sales. So sometimes you can even call it revenue. All right, the things that you have sold, but revenue is the proceed you have gotten from it. But we use them interchangeably these days. That is about purchase and sales. Then we have returns. Whilst we were in SHS, we used to call them, it is two things. We have purchases, returns, and sales returns. But those days we call them return inwards and return outwards, and it was helping a lot because you know that return inwards means that I told you anytime you are solving accounting question, take yourself as the owner. So return inwards will be that okay, it is coming to me. So it was a sales return. I sold something and they found faults, so they are bringing it back to me, right? And when we say purchases return, I bought something and found that something is wrong with it, so I'm taking it back. So outward. It's like how we used to in the P&L. Is that how we used to talk about carriage outwards, carriage inwards? So return inwards is sales returns. We sold something, they are bringing it back inwards into the business. I am the business. Then returns outwards is I am sending it out. All right. So, and mostly returns inwards is like what they call in the source document a debit note receipt, because you have credited yourself that you have sales, but when they bring it back, it's going to reduce the sales, so it's a debit to us. I get in, but a credit to them because they will get their money. But if we are sending it, that one it is a credit to us because we debited purchase account that we have purchased, but now it is going to reduce the purchase because we are sending the goods back. I'll come back to them. That's why I'm rushing with them. If you have any questions, you can test it on the comment section, or you can test my active line 059 168 6149. Say and as a Asante 059 168 6149. That is about purchase returns and then sales returns. Now let's talk about quickly creditors and debtors. Now I told you that creditors are people that the business owe, and then debtors are people who owe the business. But the right term to use in your book is not debtors but what? Receivables, because they themselves are not your assets. The receivables, what is due them. So receivables are what is due the debtors, they must pay. And then the payables are what is due to the business, to other or outsiders, people who give us what money or give us goods on credit. So that is about it. I told you in my other video, payables and then receivables. Now lastly, let's talk about bookkeeping. Now bookkeeping is the process of recording business transactions for future use. All right, recording business transactions for future use. Now remember, it is different from accounting, but we started from bookkeeping. Today I was teaching some people at Easted, formerly Amstead. I was teaching them, I was showing them the history of accounting. I told them that accounting itself came from the word count. So in the olden days, our forefathers were counting things, and after you count, you now come to account. Account means that come and render accountability to what you have counted. Then those times we used to use the clay marks, the clay tablets, and then the stones. That was what they used. Then the person we call the father of accounting, Lucas Pacioli. I don't know if I got the name right. Right, he brought about bookkeeping and the double entry approach of accounting. Okay, so bookkeeping is that let's record them down. All right, let's record them down. We can't take everything in our head. Let's record them down for future use. Then we built upon it. So accounting, financial accounting or accounting is the build up of bookkeeping, because bookkeeping has no summary. But accounting will now, after recording, it will summarize. Okay, it summarizes the information for the user to be able to make informed decisions. Ladies and gentlemen, we started accounting equation. We said that it is the expression of assets and their source of finance. We made mention and due diligence to the net asset approach and the working capital approach. Then we talked about drawings. We said that either goods or cash, that is withdrawn from the company for personal use by the owner, made mention of expense and expenditure. Expenditure has two forms. It's either it is capital or revenue. And we did due diligence to that. We said revenue is different from income. And then we made mention of profit and loss, and then purchase and sales, returns, purchase returns, sales returns, creditors and debtors. And then finally, we spoke about bookkeeping. In our next video, we'll be doing the qualitative characteristics of financial accounting. My name is Senes Asante. If you have not subscribed to my video, you are not doing well. Subscribe, share the link to any accounting student, and be a blessing to them. We are helping ourselves. All right. If you have a personal difficulties, you need help, you can text my line 059-168-6149. Now on 18th and 19th of March, I'm meeting my CA students online. If you wish to join CA, if you wish to start your CA journey, text me right after the year 059-168-6149. These days, even SHS students are doing their CA. So please, let's get involved. As accounting student, it will be good for you to chatter. And I'm going to help you, assist you, give you the do's and don'ts, the techniques that you need. And I believe that is going to be powerful. The Lord bless you. If you're a student and you are watching this, may the Lord give you retentive memory. May He help you understand whatever you have learned. In the mighty name of our Lord Jesus Christ. Amen. My name is Senes Asante, and I love you. Have a wonderful time. See you in our next video. Bye-bye.